Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about some unusual housing inventory numbers and to give a preview of Inflation Week. Before we dive in, I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
Wonderful to be here, Sarah. It was another fun-filled weekend, of course. We had another Trump IPO post about, the New York Stock Exchange. And, it finally happened where a lot of men finally kind of threw in the towel on the Redfin, the biggest seller-buyer gap in history. So a lot of people just went with that as, Redfin's median price data is going to really start to tank big. And I was like, that's not what they're kind of saying, but they went with it. Well, now it's mid-August, and that's been out for a few months. And the pricing for Redfin, it started to decline noticeably in June of 2022. So we have a little bit of duration time. Not only does it not look anything like 2022 data, which their seller buyer chart doesn't even show anything. The Redfin's median price data is firming up that it's creating a bigger gap between 2024 data. So people threw in the towel because we wrote in this weekend's tracker that inventory fell. New listings data is negative year over year. The price cut percentage is stable. What's going on here? So I had to do a little helpful presentation on X just to give people an idea, like you should do 2022 modeling out here. But we'll talk about that today. It'll be a fun topic.
Okay, so let's dig into inventory because this is a really interesting story. It was the focus of your tracker this weekend. So tell us from your perspective why this data is different right now than normal.
Okay, so we believe in economic models. We believe that every American man that people listen to should show their forecasts in their models, which none of them do for a very long time now. But what we have seen in our data since 2022, that when mortgage rates head down towards 6%, the supply and demand equilibrium changes, right? We had that at the end of 2022, which was the craziest time ever in US housing economic history. So it was tested by a very high velocity event passed. Last year, in 2024, when mortgage rates went from 7.5% to 6%, the supply and demand equilibrium changed so much that my forecast was going to be wrong. Like I was like, oh, I'm going to be wrong. I'm going to be too low. Now, let's go back to the end of June. What do we say in June? It just looks like it's stabilizing. We're not near 6%. It just looks like it's stabilizing. Okay, here comes July the 4th weekend. This 2 weeks are going to just really mess up everything. But let's just hold after the July and see what happens. So what's occurred is that the inventory growth this year was the best story. It was like 33% really at the highest year-over-year growth print. That's now down to 24%. What's occurred is that the data is stabilizing, but it got to the point to where inventory fell on a week-to-week basis. That does not happen in August in recent history. Maybe in the past, but so we're now have to keep an eye on is if rates keep on going lower, are we going to have maybe a little bit early? And we brought this up a few weeks ago. Are we going to have a little bit early of a seasonal demand curve lower because new listings data has not been doing well recently, and it had a negative year-over-year print. I could explain why, but it had a negative year-over-year print. The comps for 2020, 2024 was the second lowest new listings print ever in history. So now you have tangible variables all working in together. And these poor men on social media were putting all their eggs into the price basket of 2022 for Redfin's, and the Redfin's data is firming on them. So you can understand there was just like this white flag over the weekend that was finally risen because Redfin provided their data last week too, and it was just it wasn't heartbreaking. It was good to see that people are like, I want to learn. Right. And we always say in educated society, people that don't burn books but read them are usually do better well in life. So it was a fun teaching experience on X. I showed everyone what happened. We did this podcast, one of our in 2023. So very positive in a sense, but it makes the data a little bit more interesting, especially if mortgage rates fall towards 6%. We wrote a lot of articles about mortgage rates last week. So I encourage everyone, read them all, keep an eye on the tracker. out there. We have the HousingWire tracker now. You could link it up on HousingWire to just get to it right away and just follow the data. And remember, we're well ahead of everyone else. By the time you hear it in traditional media outlets, it's just going to be too late. Be ahead of the curve. Don't be behind.
So just more information, housingwire.com/tracker. That's all you have to put in, and you will get to the housing market tracker, and you can see all of the ones that Logan has done. You can see all the charts that Logan breaks out in that. You can click onto them. We've made it really easy. I'm super excited about that page because we get so many questions about where can I find the tracker? So we have made it easier. housingwire.com/tracker. Okay, so let's talk about that inventory piece because I think it's still surprising to people the correlation between mortgage rates and inventory, right? Most people think that lower rates means more inventory. Tell me why that's not true.
Sarah, are you in one of those groups?
I have been in one of those groups. I am now thinking, I've now seen the data for several years, so I'm less in that group.
Okay, so the funny part is yesterday's podcast, because we talked about it on Friday, I said, now that we're below 6.64, and the reason why we go 6.64 to 6%, we're not throwing up numbers. We don't believe in that. We believe in modeling out, and what we've seen since 2022, that 6.64 down towards 6 changes the supply and demand equilibrium. It changed it so much in 2023 that it took like till April to find the seasonal bottom, and mortgage rates went up to 8% toward the end of 2023. So inventory is able to grow all the way out to November. Like we didn't have the peak of inventory until November of 2023. But here, we're not at 8%. We're not at 7.5%. We're not even at 7%. So did lower rates create inventory to decline, which would follow how, Mike Simonson and myself have the same answer. We just come at it at different ways. But we're going to have to wait to see the rest of this month in August, because, when you start getting in September, you could really start making a case that, okay, we're like the past few years, October, November was the peak of inventory. So August would be very, very, so we'll keep an eye on it, but we're not near 6%. That's not happening. So that was one thing about the new listings data going negative year over year, noticeably negative year over year. That caught everybody by surprise, but I do have an answer for this. I remember because last year I was hoping I'd get 80,000 in my new listings during the seasonal peak month. Didn't happen. So last year at this time, we had a spike. A 1 week spike that I was like, oh my God, if I get one more spike like this, I'll get my 80K. And it just fell back. So it was an abnormal spike in the data last year. So it was an abnormal year over year print. So I wouldn't put too much weight on it. If it was that, I'd be like, okay, this is something I really need to focus on. But I would tell everyone the new listings data in 2025, if I compare it to 2022, since May 23rd, when it peaked around 83,000, is actually below 2022 levels the majority of the time right now. So reason we say that is that when new listings data declined in 2022, it spawned 2023 to have the lowest new listings ever recorded in history, right? Remember all these people, everyone's going to rush to sell their homes and get out of, now. So we do not want that to happen again. Right. So if this didn't have a 1 week explanation, I would be concerned. But I think we just go back to the normal trends, because the best story, the growth rate of inventory picking up, we got to the bottom part of 2019. But it does look like the recent peak, unless rates if the 10-year yield goes up and rates rise, this variable changes. Like we've always talked about, higher rates, higher inventory takes days. But you've got a functionality of new listings data declining, lower mortgage rates. Sellers are calling it quits and just say, okay, I'll just go at it another time. Put them all together, it can maybe explain inventory falling in August, in the first time since many, many years we haven't seen that. But it just makes the tracker much more fascinating going out for the rest of the year, especially if rates do get toward that 6%, and that 6% has duration, unlike before.
I appreciate this context, because if you didn't know, hey, this is why this 1 week looks different, imagine the headlines that could be spawned just from that.
Oh, and, yeah. I mean, that was just like, I teased that out on X, and everyone's like, whoa, wait a second. What do you mean negative? Yeah, there's a seasonal decline that happens every single year. There's seasonal increase, but we haven't had a negative print. There's no holiday here, right? What I mean, it was a noticeable print. Like just by itself, you'd be like, whoa, that's something big. That would actually be a material thing. But for this last week, I could explain it because last year, I remember it well. I'm like, oh, new listing spiked. I just need one more week. I could get 80K. I get it. And it just got completely, that was it. And the next week it went down again. So
again, another reason for people to follow the tracker so they know these things. And like this next week, does it fall again? And then you have to really look at why, or sure enough, was it just a fluke?
I'm hoping that we haven't seen the seasonal peak, but again, this all started the last 2 weeks of June, which the irony was like the last 2 weeks of June was supposed to be the big decline in prices because Redfin had the greatest seller buyer gaps in history. So I totally get it. If guys, you got led by something that was never telling you that. So now that we're in August, right? The seasonality of housing starts to kick in. So in a few months, you got to start prepping for 2026. But man, just so many people were bummed. And it's just like that gap between 2024 pricing now and Redfin's data is just, you can't ignore that. So tracker is here, multiple variable sets. We don't just do inventory, we do the economics. I'm an economics guy. So the 10-year yield, mortgage rates, everything. And then why is it important now? Because it's inflation week.
Yes. So that's my next question. Let's talk about those economic factors. What are you expecting and how could it affect mortgage rates?
So naturally, this is going to be the first test after that jobs report. If we have a hotter CPI and PPI inflation, what does the bond market do? Now, normally the bond market would go up, but now it going up with the 10-year yield with spreads being good is a little bit less impactful. But now you get into this battle because the Fed is not near neutral policy. It puts them in a bind. Because as Jerome Powell says, the labor market is strong. If you're looking for work, tough, but still the labor market is strong. So it's a tough spot between now until September, and we have one more jobs report, and usually you don't have like back-to-back real negative jobs report, like something like that. But to me, this will be the good test case because right now so much of the forward-looking pricing is already in. Of the rate. If I knew the rate cut was happening where the 10-year yield and mortgages right now looks perfectly normal. Again, we've had all the big moves in mortgage rates heading lower, all kind of happened before any rate cuts. So that's not, people shouldn't go, well, let's wait until September. That's not how it works. So I'm waiting to see how the bond market reacts. If it's a strong report, if it's a softer report, do yields finally break under that 418 level? We've only been able to break that really with Godzilla tariffs, and that was a market anomaly. So very interesting week. By the time anyone listens to this podcast, the report's already out, so we'll take it closer. But it becomes a really good fight now between labor and inflation and the Fed and Jerome Powell and the mutiny that's happening at the Federal Reserve against him.
Well, there is a lot going on over there. Let's just say that there's just numerous stories. We have to decide every day in the newsroom or you and I, like, what are we going to cover? Because multiple things happening. It's like we always try to stay really tightly focused on how does this impact, housing, mortgage market, real estate agents, title, appraisal, home building. I mean, that's what we're trying to focus on. And there's just a lot that we could talk about and that we do talk about. We report on a lot of it.
Economic cycles are very beautiful. They're waves and dances between data lines, but everything revolves around the 10-year yield. So that's just my thing, right? The bond market revolves all. So, and just remember 65 to 75% of where the 10-year yield and 38 mortgage rates can range in within a cycle is still Fed policy. Nominal growth, inflation expectations, labor data, those are the things that can drive that within a cycle. But we're in like a little precarious position here because I think the Fed wanted more time to wait on tariffs, and that labor report was just Powell just like, if he just had a few more days, things would have changed. But that's the exciting part. And we said this July 1st, man, the second half of 2025 is going to be lit. There's going to be a lot of different variables, and Halloween. Man, they're selling Halloween candy already.
I
By
know.
the
I
way,
saw that.
did you see my AI?
Oh, yes.
Yes, where
That was
I'm
super creepy.
having coffee in New York, and all of a sudden a demon vampire creature was right behind me, about to. I was like, "Is everyone ready for Inflation Week?" So
Okay, so quickly before we go, we're trying to keep this a little bit short today because we have all sorts of things going on. I did want to revisit the story that we wrote over that you talked about at the top of this, which was that Trump seemed to indicate that, like, hey, we could even have that to support the story that came out on Friday that, yes, he wants to do an IPO of Fannie and Freddie before the year is out. So he then put on Truth Social a picture of him at the New York Stock Exchange, obviously some sort of AI picture, and it had like a new Great American Mortgage Corporation, something like that, seemed to do that. But tell me your take on that, because I thought it was really interesting.
well, like we said, test test balloons to kind of see what it happens. I'm just assuming that Bessent and the people in the White House that are working on this went to banks and had a discussion, and went to traders, right? Because if you're doing this now, you've probably I'm assuming they've talked to banks and traders on what's going to happen, what do they need to say, and they move it forward. Just for everybody to, like, people were asking me this. I do not own Freddie or Fannie shares. I do not plan to invest at all into this. My job is the economics of this. I don't care about the investment side. I've given presentations to Wall Street, people who manage $2 to $3 trillion on builder stocks, but I talk about the economics of it. I don't own anything or anything like that. This whole thing, I think the timing was crazy because we talked about it on Friday, and then the next day this happened. So I have no privy or no information about any of this. But going out in the future, I think we should get a little bit more clarity on how much they're going to sell. What are the terms? What's the guarantee that the government's going to do? But I'm just assuming they went to traders and bankers to see what can they do and make sure that pricing doesn't get impacted anything. Especially now that mortgage rates have come down a little bit and spreads are a little bit. I think Bassett said himself not that long ago, we're not going to do this if mortgage rates rise, and we're going to make sure that the spreads get better. So again, there's a lot of things going on. That was just, what happened over the weekend. And we just, like we said, the second half is going to be lit, and it's only August. So get ready for some fun.
That image that he shared had November 2025 on it, right? As if he was doing that. But everyone we've talked to is like, there's no way to get that timing. Like, it's hard to see a path toward timing by the end of this year.
They're just gonna have to wait to see details. But I mean, the test balloons are out there. Obviously, there's not new information in terms of details as of Monday, but over time, things should be leaked out. But this is not abnormal to just throw something out there now to kind of get the market response. And we'll take it one day at a time. Of course, the last podcast was my take on it. Freddie and Fannie, they functioned very well. Whatever you're doing now better be on par or better than before. It can't be worse, because it just, but these are two humongous giants that are just gems of the United States of America, that the envy of the world, right? They hate us for many reasons, and this is one of them. No other country has the plumbing system as we do. And I've known people that have traveled in other countries and talked to other governments to try to replicate this, and they just don't have it in their economic system to even do something like Freddie or Fannie or FHA or BA or anything like this.
Okay, well, Logan, thank you so much for weighing in on these important topics. We will talk to you again soon. Appreciate you.
Pleasure, Wheeler. The week's early, and get ready for some fun in Inflation Week.